Welcome to Wealth Matters Podcast. I have with me Brian Adams. He's a recovering attorney hailing from a family office background dedicated to providing investors with direct access to institutional alternative investments that can generate passive income in a tax efficient manner. He currently serves as principal of Excelsior Group, which he founded in 2019 and oversees acquisitions, operations, and capital raising efforts. So I'm looking forward to the episode because I have never invested in commercial office space. And as most of you guys know me, my listeners, that I love diversifying. I have been investing in single family to multifamily, recently senior housing to mobile home parks. So I'm always looking forward to learning about new real estate assets. So welcome, Brian.
Thank you for having me, Alpesh. I really appreciate it.
And feel free to add if I forgot anything from your bio.
No, I think you covered everything. I have two little boys, and I'm a huge hockey fan. But other than that,
Oh, huge hockey fan.
real
Nice.
real estate is. I think you covered all the basics.
Perfect. Yeah. Actually, I was going to ask you, tell us something interesting about yourself. And I think you mentioned hockey. If there
hmm
is something else, let us know.
Yeah, no, I mean, I've got three jobs. I've got real estate, and then working with my wife's family office, doing a bunch of different things, and then
Oh, okay.
being a dad to
That's a
my
full-time
little
job.
boys. Yeah, so I've got three
Oh,
jobs, and so yeah.
yeah, yeah. Yeah, I tell my wife I got two daughters as well, young, so I know.
It's work, but they're great. So
Absolutely. So how and when did you start in real estate?
yeah, so I'm from New York originally. I met my wife in college in Connecticut. We went to a small liberal arts school together, and she is from Nashville, so she's a Nashville native.
Oh, okay.
And her family has a single family office based here in Middle Tennessee, and they've been involved in the real estate business for a long time. So when I practiced law for a couple of years and then got exposure to some of the investments we were making, some of the sponsors we were working with, the GPs, et cetera, and
Right.
I fell in love with the business. I thought real estate was a
Oh,
terrific
okay.
business, a great investment, multi-generational wealth creation. And so I connected with my partner, who's another New York guy that married a Nashville girl.
Oh, okay.
And we started our company about 10 years ago.
Oh,
Um,
okay.
Initially in Nashville, and then we started expanding geographically. And today we have about 2.5 million square feet under management. So the portfolio value is probably 350 million or thereabouts. And we're in 12 markets.
That's awesome. So you are someone who has seen from family office perspective, who has seen, that real estate can build generational wealth, right? Because of course you and I are young, and we haven't done that, or so we can't prove it ourselves. But you have seen it from family office perspective. And where does that family office invest, or what asset type? Do they invest in all different asset types, or they are focused on certain?
Yeah, there's a saying in the family office world that once you meet one family office, you've met one family office. So every family is different
Uh,
in terms of how they want to allocate. But I would say, based on anecdotal evidence, just from my experience with my investor base, and then reading some research, it's pretty typical as you would think. They have a decent exposure to real estate. A lot of it's multifamily, a lot of it's triple net retail, a lot of it is office, a lot of private equity exposure,
uh-huh.
and then just the overall market. So it's hard to pin down
Right.
exactly because every family is so different, and it's a little bit,
Yeah.
but it's what you'd expect. I mean, they have, historically these families created wealth by massive concentration in one asset class. And so typically when they want to maintain that wealth over multiple generations, which frankly is pretty difficult once you talk about inflation,
Right.
operating costs or overhead or spend rate, and then your family grows exponentially, right? You have two kids, I have two
Uh-huh.
kids,
Yep.
they each have two children, and you know how that goes. And families realize that the only way that they can kind of beat the market is by taking on illiquidity private investments. And so,
Right, right.
usually they have a pretty broad exposure to the alternative space.
That's great. So, why did you choose commercial office buildings? Because uh, means I invest in multifamily to more on the residential side, and that senior housing, I still consider that as residential. How and why did you choose commercial office building?
Yeah, when we got into the business, this was even 10 years ago, multifamily was just hyper competitive. So
Yes,
a lot of people looking for deals, cap rates were going the wrong direction.
right,
And, increasingly what used to be an A product was a B product, et cetera. And so
right,
it seemed like a pretty crowded trade. And when we went to our investor base, for the most part, they had exposure to multifamily, but
right.
office, for whatever reason, office was a situation or it was an asset class that they either could get it through like a Blackstone fund of funds or a KKR Carlyle kind of big
Mm-hmm.
Wall Street product, or they could do a one-off deal with their buddy from the golf course. But there was really nothing
Right.
between. And so we wanted to bring that institutional deal flow, institutional style asset management to the accredited investor family office space.
That's interesting. And I agree. So if you are talking about 10 years ago, if the multifamily market was competitive, it's like ultra competitive right now.
Yeah, I mean,
I
it's crazy, and I understand it because it's an approachable asset class.
right.
For the most part, it's kind of like education. Everyone at some point in their lives has lived in an apartment building, and so you think, well, I can
Yes.
understand this and I can do it.
Exactly.
But for us, the way we think about real estate is we like to be north of an 8% cash on cash yield,
Yeah.
and unless you're going to take a lot of leverage or risk, it's hard to do that in multifamily today. So,
Right.
office, we've carved out a nice little niche, and we can still find 7 to 8 cap type opportunities in these
Nice.
markets.
Okay. Yeah, because multifamily now it's 4 to 5, and
Yeah.
that also then you got to do value add, and it's very competitive. I decided to get out of it last year, so I now focus more on mobile home parks and senior housing because I think that's where the market is,
Well, even in
headed.
office, cap rates have gone down. I mean,
Yes, it's everywhere. Of course, cap
it's
rates have compressed,
yes.
but everyone wants to be a multifamily investor. That's the problem.
Yeah, yeah, and it's a great asset class. My family
Right.
still has investments in multifamily, and it's terrific. But it's just a crowded trade, and
Yes.
I don't like competing against people who are really really smart that that are well capitalized. And so I'd rather go elsewhere. We've carved out a place in that $10 to $20 million price range where the buyer pool is just not very deep. It's below where private equity will go, but above the syndicators. And
Right.
so, we still have a little bit of a pricing premium there.
No, that's a great point. So, how different, or I don't know if you have invested in apartment buildings and all personally, but how different is investing in office building from, residential apartment buildings to mobile home parks to even single families? What have you
Yeah.
seen?
Yeah. So fundamentally, for the most part, it's all pretty similar in terms of the structure and the capital stack and all those things are going to be very similar. I would say the biggest difference in that it's good and bad. Um, for the most part, we're talking about 5, 7, or even 10-year long leases, right?
Right.
So you have a lot of stability. Sometimes it's not as attractive as multifamily because with that stability, you don't have the opportunity to raise those
Raise
rates
rents,
in a
yes.
very
Correct.
dynamic pricing structure where
Correct.
obviously hotels you can change your rates every day.
Yeah.
Multi you can change it every 6 months or 12 months. Office it's more stable and less volatile, but you're losing some of that pricing dynamic. So
Right.
if the market is doing well and you think, gosh, I could push rents $2 or $3 a square foot, you've got to wait.
Yeah.
And I think the biggest misconception for office is, and where people have been burned, tenant improvement and leasing commissions are big expenditures, right? So
Oh, yes.
you've really got to underwrite appropriately so that you can maintain your yield. And so what we do is every year we do a cash sweep. So we take excess amount of dollars, we do it on a per square foot basis, and we put it into an account, and that account accrues every year, so that when you do have a tenant that wants to renew, or you have a tenant rolling and you've got to backfill them, we don't have to go to the lender for more money. We have our own capital
Makes
account.
sense.
We don't have to do a capital call to the investors, and we can still maintain. We'll probably have to reduce the yield.
Right.
We can still maintain that quarterly coupon.
So you are well capitalized.
Yeah,
Right.
that's the key, is front end loading, and then having a structure where you have the ability to provide TI and LC dollars without having to go to the lender, because you don't want to negotiate with a lender that doesn't understand the dynamic of your assets.
Right.
And that was through years of making mistakes and doing it the right way.
Yeah.
So,
That's what I keep telling people, that unless you take action, you are not going to learn. Means you can read as much book as you want to, but unless you do it, you are not going to see it.
And for office, I think it's important to also understand, and this is a mistake we made early on, if the market's doing well and rates are moving and there's a lot of leasing momentum and absorption in a market, that's great. But as a landlord, if you have a property that has a lot of little tenants, and you think, okay, good, I can push rates, I can push lease terms, I can get credit, but it's very expensive, right? So we've really pivoted towards a model of, we have higher concentration of users in our assets, but the credit is much better. And that really cuts down on that cash churn that you hear about, that why people don't like office. We try to take that out of the equation to the extent that we can.
Interesting. So what are some of the data points you follow when evaluating a city to invest in?
Yeah. So it's very similar to multifamily. The way I think about it is, and especially in what we're experiencing in COVID,
yes,
where there's an acceleration of all these trends that we've been seeing coming down the pipe, and now they're coming really quickly. I love tracking multifamily data, because for me, as an office guy, it's all about job growth, it's all about population growth, and it's all about wage growth, right? I mean, that's what drives office.
Those all three migration patterns, right? Yeah, all of
so
those.
The way I think of it is, if people are moving to, Kansas City, and it's the right demographic of people, well, employers are going to come and try to have a footprint there to take advantage of that human capital, right? Yep. So for us, the way we look at it is, million plus cities, MSAs, but outside the top 10 traditional gateway markets.
Right.
So we're in markets like Nashville, Kansas City, Richmond, Cincinnati, growth secondary markets.
Okay, got it.
Importantly, it's just like multifamily again. What you see in a lot of these cities is there's no geographical or geophysical barriers, right? There's it's not on the coast.
Right.
There's no mountain ranges. So you get a lot of sprawl,
right?
And that's where understanding the sub-market dynamics within the MSAs is really important.
Mm-hmm.
So we typically will only go to 2 sub-markets in every MSA, and once we find the ones that we like, that were really resilient during the Great Recession, no new construction, and what we really like to see is not only purchasing at a discount to replacement cost. So if it costs $350 a square foot to build a new building, we're typically 150 square foot on purchase. What I like to see is a discount to replacement rents. So if you're in a market like Kansas City, where Class A rents are in the high 20s per square foot, and it's going to cost $35 to $40 a square foot of rent in order to justify new speculative development, I love that dynamic, because it protects me as a landlord, because no one's going to come in and steal my tenants, because the numbers just won't work. And so that's where we spend a lot of our time kind of doing the heavy lifting on the data side. And then we like to see local economic drivers in that education, government, healthcare, STEM space, because we think it's resilient and will continue to do well for the next cycle.
Got it. So what have you seen about millennial migratory patterns?
Yeah, so I am a millennial, barely. I know I look old. But I do qualify under the Pew definition, Pew Research. So millennials are now the largest working population in American history, 75 million people. And I think there was really a narrative on Wall Street and on the West Coast that millennials were never going to have children. They were never going to get married. They were going to live in Brooklyn their whole lives.
Or San
etc.
Francisco, yeah.
Yeah, exactly. And they're going to be tech bros. But
Right.
the reality is because of 2008, they just delayed their family formation process. And
Ah,
so
okay.
now that they're having children and getting married, they're making quality of life, cost of living decisions based on where they can access single family homes, where they can access education for their children. And every generation does this. We all rebel against our parents and we say,
Oh,
we never
yes.
want to live that life, right? We never are going to do this. But for the most part, we end up living a very similar life to our parents. And so you're seeing this, pivot back to the suburbs, back to secondary markets because it was already happening. We saw it coming. But
Right.
with COVID, I think it's just a catalyst for a lot
Yes,
of people
yeah.
to finally make
It
the
has
decision.
accelerated for
Yeah.
sure. Interesting. So, another question I have is, what do you do to evaluate a deal? What are the steps you take when a deal comes to you?
Yeah. So we've kind of got our funnel of the MSA, then the submarket. We like that 10 to $20 million purchase price. That's a sweet spot for us. Then, if we're buying at a good discount to replacement cost, buying at a good discount to replacement rents, we like a weighted average lease term of over 4 years. So that means you aggregate all of the leases that are in that building. And if you average them out based on how large those users are, we like to see that in that 4 to 5 year range. And then we do a lot of heavy lifting and underwriting on the actual credit of the tenants themselves. And so all those dynamics that I talked about in the submarket, they all kind of go into this analysis that we have. And for us, we like to be in that, 7 to 8 cap range, where if we put 65 to 68% LTV on it, we're solving for an 8 to 10% cash on cash yield.
Right, which makes sense. So, what are some of the gotchas to keep in mind while underwriting office building?
I think the things that I mentioned before, you can't really be impressed enough, right? So one of the mistakes we made early on was even if the building was in a great location, had great tenants, and it hit all the marks for us, um, vintage risk has become a real problem with these buildings. So I think
Oh, okay.
buildings that were built in the 80s and the 90s, in our minds, that doesn't seem like that long ago, but they're starting to get really long in the tooth. And you think about the major things you worry about with office: roof, HVAC,
HVAC, yep.
elevator. Usually those have 25-year life
Right.
lines. So you start looking at deals that were made in the 80s and the 90s, construction, there's a lot of capital expenditures and a lot of deferred maintenance typically, and
Hmm.
elevators will kill you.
Oh,
Um,
yeah.
so we're very sensitive to vintage risk. We like to be somewhere in the 2000s range
Okay.
for new
Okay.
construction. Um, so those are things that I would really worry about if I were doing an office deal.
So let's say because we are seeing low interest rates. So if we have entered a period of low interest rates, as the Fed has indicated, where are investors to find yield? Where do investors go?
I mean, I had this conversation all day, every day with investors and other sponsors, or just folks in the financial markets. And, unfortunately, there's not a lot of great options out there. Outside of real estate, I don't see bond deals doing anything.
No,
Corporate debt seems pretty risky, and
it's very
valuations
risky.
are.
I think that's the most riskiest asset
Yeah,
right
so
now.
some of that high yield junk bond stuff, I think, is going to come back to really hurt
Uh-huh.
people. So there used to be oil and gas. You could do some MLPs, but
Yes,
energy sector has just been crushed.
right.
So I still think, on a risk adjusted basis, real estate's going to be your best bet, especially if we have inflation coming.
Oh,
That's
yes,
where multifamily and office can be really nice hedges to inflation because obviously you can push rents as
right.
needed. I personally think inflation is coming, considering how much liquidity the Fed has
How
pumped
much
into the
money we
industry.
has pumped? Crazy. But yeah. So, can you talk about one of your deal, like your best deal ever in the office space? Where you had bought at the right price and sold
Yeah,
and made.
far and away the best deal we did was one in Nashville a couple of years ago, and it was pure luck. So we bought this building, office deal, off market. Um, it had just gone through a first generation of lease renewals. So tenants were thinking about leaving or they were thinking about extending. The owner was a developer that needed to 1031 the proceeds into a new deal.
Oh, I
So
see.
we were able to get under control at a very attractive price. We did some very light value add. We did some light leasing. And frankly, we just really rode the wave of Nashville. We held it for 2 years and we made north of a 50% IRR.
Oh, nice. That's awesome.
Yeah, that
What?
was a good deal. I need more deals like that.
Right. Yeah, everyone does. What was your worst deal?
So early on in my career, we did a little bit of development and value add work. And I did a deal that was a urban infill development. I
Okay.
had everything teed up. I had some great leases. It was a killer location. I got it off market. I worked this thing for over a year. And then during construction, our general contractor made a mistake, and we were relying on a loophole in the code to allow us to do this commercial construction. And when the GC made the mistake, which ultimately is my responsibility as the sponsor,
Right.
we lost that loophole that we were relying upon, and it just turned into a whole mess. So I had to do a workout. The bank got involved. Luckily, I was able to get my investors out even, but it was the worst 6 months of my life. It was terrible.
Right.
And I don't do development anymore.
Yeah, dealing with city and county and whatnot. That's
Local politics,
right.
Just so a lesson well learned, but yeah, I don't do those type of deals anymore.
Hey, so just looking back, just with the coronavirus impact, how badly the office market has been hit, right? Because personally, I think, again, because I'm sitting on, I don't know much about office building, but I see most of these offices are unoccupied right now because they are not considered essential business, right?
Mm-hmm.
So
Mm-hmm.
what have you seen with your own deals and overall in the market?
Yeah, so I'll speak to just kind of macro level. With the caveat that I obviously am biased, right? I've got a horse in this
Right.
race, and I believe office is a resilient asset class and will continue to be a good place to put money moving forward. That being said, the Fitch ratings for CMBS delinquencies just came out earlier this week for June, and it was about 1.5% delinquency for office.
Oh,
Whereas hospitality was around 24%.
It was crazy over 20, yeah.
But that being said, it's too early to say because it's
Okay.
going to take 6+ months for some of these deals to work their way through the servicer system. And so, who's to say? I can tell you from our perspective, our 2.5 million square feet, I don't know how many tenants that is. I should probably know that. It's a lot. We had about 93% rent payment for April, May, June. July, we're still getting the numbers in, but
That's pretty good, though.
We've been pretty well protected.
Yeah.
The longer COVID goes on, honestly, it's just a matter of where you are in the spectrum. So you've got hospitality and retail here, you've got office in the middle, then you've got multifamily,
Yes.
and then you have industrial data center self-storage, which are going to be largely unaffected unless this really goes on for a long time. I think what you see is offices that are in major coastal metros with democratic governments and have tech user bases. I think they're going to struggle. I mean, when WeWork is the largest tenant in Manhattan and WeWork goes BK, which I think they will.
They will, and they were struggling before this. So I was reading, and this is not my quote, but even Warren Buffett or someone else said that businesses which were struggling or which were barely staying afloat before COVID, they're not going to survive. And WeWork is one of them. They already were struggling.
Just like we were talking about in terms of demographic movements, the same thing is, just like you said, the same thing is true for these businesses. Is if you were struggling before, COVID only makes it worse, right? It just accelerates what's going to happen.
You are really sick now, right?
But to your question, office as an asset class is a function of density. And what we saw leading up to COVID was this trend line towards massive density, right? The WeWork model where you had 75 square feet per employee and really expensive build outs and really expensive TI packages. I think the pendulum is going to swing to the other way where People are going to want more traditional office layouts with a door, more like 250 square feet per employee. Suburban office is really well positioned to take on that kind of density, and they can park that kind of density. I think what you'll see is more of a hub and spoke model where, the mothership will be in New York or San Francisco, but there'll be offices in Denver and Nashville and Austin and some of these other secondary markets. Just like '08, people are going to reevaluate how much money they were spending on office and whether or not it was necessary to obtain and retain all that talent. And so I think they'll be looking for more cost-effective options.
Got it. So this leads me to my next question. Which office market do you think will be hardest hit by COVID?
New York.
New York, of course, yeah.
And so, New York's got a real issue where, and I'm from New York, it is the greatest
density, everything.
Greatest city in the world. Right. Greatest city in the world. But you've got a real problem where there's going to be a death spiral of your tax base leaving, which means that you've got to raise taxes.
Oh, yes.
And you've got to cut services, and which means more affluent people are going to leave. And so places like New York and San Francisco, I think, are just going to, it was really bad before.
Right. It was unaffordable.
But the only option these places have is to raise taxes to make up for these budget inefficiencies. And they've still got long-term issues with pension plans and et cetera.
Yes, huge. California is struggling.
When you hear Barry Sternlicht, who runs Starwood, say that out of 300 million square feet that guy runs, he only has one building in New York City.
Wow.
Pre-COVID, because he didn't like the dynamics.
Right.
So New York, and I think a misconception is that this is kind of a zero-sum game. Like if people leave New York and they come to Nashville, it's good for Nashville and bad for New York. It's more dynamic and fluid than that, right? So as people leave the city, it allows younger folks who, want to go to New York, it'll be more affordable for them. And the cycle will continue.
That's true.
In the next 5 or 10 years, I think these major coastal cities are really going to struggle.
Yeah, I agree. So which cities are you personally looking at right now?
Yeah, we continue to be very bullish on Kansas City.
Okay.
We see Chicago imploding.
Oh, really? I thought Chicago will struggle. Oh.
Chicago will struggle. They have one of the worst budget situations.
Yeah, their tax and they have the highest outbound migration. Yeah, Illinois, California, and New Jersey, and now New York.
Yeah, you've seen the U-Haul data just like I have.
Exactly.
And it's one of those things when you tell rich people as a politician, hey, my plan is to tax rich people more, you realize that they're mobile and that they will leave. And so, I think Kansas City is going to be direct beneficiary of that Chicago implosion. And I actually like Omaha. We continue to look at deals in Cincinnati. The markets that we are going into, they change quarterly based on the data that we're seeing. But yeah, I would love to do more deals in Nashville, but it's just too expensive. Right. So I can't see us doing anything.
Yeah, it grew like crazy in the last 5-6 years.
Yeah.
So awesome. This was great. Let's take a quick break. And after the break, we'll continue with Fire Round.
Let's do it.
Welcome back to Wealth Matters Podcast. I have with me Brian Adams, and we are continuing to discuss about office space or commercial office building. Brian, I ask these 5 questions to all of my guests every week. And so this is a fire round. Are you ready?
I'm ready. Let's do it.
Okay. Would you be changing any business or investment strategy after coronavirus?
Yes. So we will obviously underwrite the credit of the tenants with a little bit more scrutiny. Okay. And, clearly if you have exposure as a business to hospitality, travel, or leisure, we're going to expect, more there in terms of credit. So that was something that pre-COVID we didn't think as much about. If you were well capitalized and you had a good credit rating, we assumed that you were in good shape. But now industry-specific exposure becomes part of our analysis. So that's certainly something we're thinking about.
Perfect. Favorite real estate or finance book?
Yeah. So even though I hated law school, one of the biggest epiphanies I had was as a first-year student, Real Property 101, the concept that our entire credit system is based on the ability to borrow money against real estate. I didn't appreciate that
Wow.
when I was young. And I've been fortunate enough to be able to travel extensively. And I don't think you probably have some more perspective on this, but I'm not sure people in the US realize that the ability to own real estate as a private individual is not true across the world.
No.
Oftentimes you have leaseholds, which I just, fundamentally, conceptually don't understand how that would work. So that book, changed my whole life about just how the market functioned. And you can see what in '08, what happened when you forced too many people to own.
Yes.
But it still is the basis for how we conduct the entire economy.
Right. Any tool or website you recommend or you personally use every day or for your business?
For news,
Yeah,
um,
for anything, maybe to find deals or you can't live without.
yeah. So I've become a huge LinkedIn junkie.
Yeah,
I
and this
just
is
think
what.
it's incredible. I mean, it might be how we connected. I don't
Yes,
remember,
yeah,
but
this is how, and my earlier guest as well mentioned the same thing. Yeah,
it's
I love LinkedIn now.
I was on it before, but with COVID and the quarantine, I just really nerded out on it and started listening to podcasts and reading things and books and best practices. And for me, it's an incredible way to meet investors and really connect with them and show them my thought process through my postings and provide them content.
Yeah.
And it's just expanded my network tremendously. So now I'm totally addicted. I could not live without
Yeah,
LinkedIn.
I love LinkedIn.
Yeah, it's great. And just being able to meet people like you and
Yes.
share thoughts and ideas and best practices, I think it's a really beautiful community. And seeing what's happening with these other social media platforms, I
Right.
really appreciate LinkedIn just being more of a professional place where
Uh-huh.
people are trying to build their businesses.
Yeah, that's a great point. Any advice for beginner investors?
um, Real estate is a very capital intensive business. And if you don't feel
Yes.
comfortable pitching and being told no, it's not the business for you.
Got it. No, that's a great advice, actually.
When I meet an entrepreneur or I talk to somebody who wants to be in the business and I ask, okay, well, how are you going to go out there and raise, and what's your thought process on marketing and business development? And they say, oh, well, I'm going to hire a salesperson.
How are you going
Wrong. If you're not the chief salesperson, you will fail. If there's not
Right.
somebody in your organization focused on the capital side of the business 24/7, you will fail.
Right.
It is just very important, obviously. And I'm not sure. I think a lot of times people get excited and they say, oh, I got this great idea and this great team. But unless you have capital to close that deal, that's just an idea. And an
Right.
idea is not a business.
Nope. How do you give back?
Yeah, so we have a corporate sponsorship with a local food bank, kind of like Second Harvest, only it's only in Nashville. And
Okay.
so right now they're not open to volunteers with COVID, but we do food drives or just donate money there. So we're focused on food security and trying to eliminate food deserts in Nashville. It's in our own backyard.
That's awesome. How can my listeners reach out to you, Brian?
Yeah, like I said, I'm very active on LinkedIn, so you can look me up. If you message me, I'm happy to connect. I'll try to tell you, best practices. Maybe I'll try to help you raise capital. I can probably tell you what not to do because I screwed up a lot. But yeah, LinkedIn, and then you can check us out on the website, excelsiorgp.com. And, please reach out and let me know how I can help.
That's awesome. Thank you so much, Brian.
Yeah, Alpesh,
Have
thank
a,
you for having me. It was really fun.
yeah, same here. Have a nice weekend.
Okay, take care. You too.
Okay.